Joining us from Sydney is Richard Grace. Now, he is head of FX strategy at Commonwealth Bank of Australia. Richard, really good to see you there. Let me just ask you what you might be expecting from the Fed later on, and what sort of effect, whatever they do, might have on the FX markets.
Yeah, well, thank you. I do expect an operation twist, an extension of the Fed's extension of duration in the Fed's balance sheet, if you like, selling of some of the short-term bonds and purchasing the longer-term bonds in an effort to flatten the curve a little bit. The impact, I think, on the US dollar will be very muted, mainly because I don't expect too much impact at the very short end of the curve. I think any spike we get in yields from any Treasury selling will be quickly result in buying from elsewhere in the market. We'll see the two-year yields go back down to in conjunction with the Fed's guidance of keeping the Fed funds rate at current levels until the middle of 2013. Now, the US dollar is much more sensitive to movement at the front end of the curve than it is to the back end of the curve, so this is why I expect very little impact on the US dollar from the Fed announcement of an extension in the portfolio's duration.
Now, as we know, the IMF has cut growth targets. Greece is still in a pretty big mess. Where do you stand on the euro? Where's that going?
Look, well, we think there's some more short-term downside risks to the euro, possibly seeing the euro go as low as 130, 150. If the developments in Greece continue to take a turn for the worse, I think the middle of October is really a testing time. Between now and the middle of October is really a testing time for Greece and for the euro. But look, I think by year end we will see the euro climb back to close the year around 139. And over calendar 2012 we'll see the euro back above 140. But for now there's certainly more downside risk between now and the end of the year, particularly between now and the end of or middle of October for euro.
No, that's quite a high target for the end of the year, because it is quite incredible, despite what's been going on globally and despite the real mess that Europe is in at the moment. It's only lost 1.6% in the past 12 months against a basket of currencies. So why is the euro just so resilient, and why do some traders actually look to that as an alternative to the greenback as far as investment is concerned?
Well, look, I think it is a major alternative given the liquidity of the currency. You can just gauge that by central bank activity. The central banks hold 27% of their reserves in euro. But if you look at the resilience, that indicates you get some of the central banks coming in and buying on dips because of the alternatives to the US dollars. But let's look at the current interest rate pricing. A lot of interest rate cuts already priced into the front end of that Eurozone curve. We're not seeing euro dip significantly despite those interest rate cuts being priced. But also, let's keep in mind the fact how small Greece is as a percentage of total Eurozone GDP. And while it's clearly generating financial strains, our central scenario is, despite some unfortunate developments in Greece, it's not enough to see significant and sustained downward pressure on the Eurozone. And I guess that is reflective of the fact that interest rate cuts are already priced in, bond spreads between the euro and the US already narrow, and you still can't get that downside pressure on the euro such that it breaks back through 130.
Richard Grace from the Commonwealth Bank of Australia, live from Sydney. Thanks very much indeed for joining us here on Bloomberg Today.
Thank you.